Okay, so we're going to get rate announcements tomorrow in both Canada and the United States. Let's get more from Etienne Bordeleau-Labrecque, VP and Portfolio Manager at Ninepoint Partners. It's great to see you. Thanks for joining us.
My pleasure, Andrew.
Let's start off with the Bank of Canada. You think they are going to stand pat on rates?
Yeah, I think it's been well telegraphed. Governor Macklem several times told us we are in a good place. We lowered rates a lot. There's a lot of uncertainty. And we need to see how this plays out, this push and pull between a weaker economy on the service side, services inflation slowing down, housing slowing down, at the same time goods prices moving back up because of the trade war. And so core inflation in Canada has been around 3% for the last several months. So I don't think they're very happy with that.
That's higher than the 2% they want to see.
Yeah, exactly. Yeah. So headline inflation is distorted by the removal of the carbon tax by the Carney government, but if you look at core inflation, it's not going in the right direction. So I think that doesn't really give any ammunition for the Bank of Canada to cut rates tomorrow.
And this is even before the tariffs kick in.
Yeah, we have seen a little bit of pass through, and it's really a matter of how much they want to retaliate as well. We haven't really seen a trade deal from Canada. Yet. Most other countries that have cut a trade deal with the U.S. have decided not to retaliate, so they're taking a big cut on their own tariffs and essentially seeing most of their goods tariffs going into the U.S. So it remains to be seen what happens with that, but we're starting to see a little pass-through, but not a whole lot.
Could we be done with interest rates by the Bank of Canada?
Yeah, some people say that that's the case. Some people still think that they might be cutting a little bit more. Right now at 2.75%, we're right in the middle of what they call the neutral rate range. So that's the rate of interest that doesn't stimulate or constricts the economy. The trade war has impacts on very specific sectors so far: steel and aluminum, copper, the auto sector. So monetary policy is a very blunt tool. And so perhaps it's better for the federal government to intervene and help these industries very specifically, as opposed to a massive dose of monetary stimulus.
You and I both just renewed mortgages, and I think I went fixed term. I think you did the same, because I was worried that inflation could surge and push up the cost of a variable mortgage.
Yeah, so if you think about the 5-year fixed mortgage, it's really dependent on what 5-year rates do. So
bond yields.
What the Bank of Canada does is not that relevant to a 5-year mortgage. 5-year mortgages are backed or linked to what 5-year interest rates do. And what we've seen so far this year is, think about the Bank of Canada, we've cut 50 beeps this year, but the yield curve has been steepening, meaning 5-year interest rates are roughly flat from where we started the year. 10-year and 30-year rates are actually higher. So if the rate cut cycle is over, and I'm not saying that's the case, but if it is, then we should expect a further steepening of the curve. That's historically what has happened. So you might have done a good thing renewing your mortgage at a fixed rate for 5 years, because 5-year mortgage rates might be going up a little bit, not down.
What about the Fed? You see them standing pat tomorrow as well?
Yeah, it's even clearer at the Fed. They want to see how this passes through their economy. The trade war is much more important for them than it is for us at this point. The U.S. economy is going to be faced with somewhere between 15 to 20% average tariff rates. This is a very large shock, and the cadence of how this feeds through the economy is important. So first, there's a lot of imports in front of the tariffs. So we've seen that. That's why Q1 GDP was so weak. Now we're going to see Q2 GDP tomorrow morning. We expect to see a rebound because net exports will be dropping a lot because imports are off. But then we'll see the impact of the tariffs going through prices. But then also some companies might decide to eat some of the tariffs and take it on their margins. What will that do to employment further down the road? So expect to see price impacts this summer and potentially impacts on employment maybe in the fall, later in the year. So the cadence is important. If you're the Fed, you see prices hit first, so you probably want to stay pat on interest rates. And then if the labor market deteriorates later in the year, then they have room to cut rates.
Sounds a bit stagflationary, though. Prices going up, employment jeopardized.
Yeah, stagflation, like in the 70s, was much worse. I mean, inflation was high single digits, low double digits. Unemployment was much higher. the unemployment rate in the US is only 4.1% right now. So it's stagflationary light, if you want. We're not really seeing very high levels of unemployment, but we're also not seeing inflation coming off the 3% level for a while because of the trade war.
I guess one thing about these trade frameworks that the White House has been reaching is we don't know the details. And I wonder when things pan out in reality, maybe tariffs won't be that bad. So there'll be exemptions, because we don't have properly detailed negotiated deals here. Yeah,
so trade deals take a long time to be reached. But one thing seems very clear, 15% seems to be the lower bound for tariffs out of this administration. They don't really seem to want to negotiate anything lower than that. And there's court cases going through at the moment with regards to the legality of the use of certain tools that they use to impose these tariffs.
The so-called threats to security and
exactly.
Stuff like that.
So, but then there's other ways that they can pivot and impose tariffs through other sections of the code. So they can do 232, which is what they've been doing for cars. Steel, aluminum, and now copper, they're threatening to do that. So, and they'll probably do pharma as well. These are just less flexible, so it takes more time to put them on, but they've had plenty of time now to start preparing these cases. So I suspect tariffs are here to stay, and we should learn to live with them.
And I'm just trying to think, in Canada, is there any risk that the Bank of Canada would raise interest rates if inflation really heated up? Well,
we have to ask ourselves, why would inflation really heat up? At the moment, goods inflation, food inflation, because of the countervailing tariffs, is starting to move up a little bit. But if you look at services inflation, which is the other half of the inflation basket, house prices, rents are going down in most of the country. And on the aggregate, it's going down. So that's going to prove to be a deflationary force. The labor market is very soft. Unemployment in this country is 6.9%. In Ontario, it's almost 8%. So what's going to be driving inflation high enough that the Bank of Canada needs to start hiking rates again? You need to see a very large shock on the goods front, which I don't think is going to happen.
It's interesting. I mean, the Ford government has overseen a province whose economy has underperformed the rest of the country.
It's really rare to see that. Typically, Ontario's unemployment rate is in line with the country or better. And you have Atlantic provinces that typically have a higher unemployment rate, and now it's completely opposite. So a lot of the industries that are affected by the uncertainty around the trade war are in Ontario. Plus, we had a 15-year bull market in housing, which we're probably starting to see a little bit of an overhang. And unemployment going up is not helping. Historically, you only see mortgage defaults going up when unemployment rises.